All right, we are live. Today we're going to go through this macro report, this week's macro report covering sort of what are the economics we saw this week, right? So the economics we saw this week, what was the economic data? What are the technicals sort of looking like? What is the what is the Fed policy looking like? What is the second half look like? What do earnings look like, right? So we got a couple of things, a couple of concepts to get to. And really this report is just highlighting that yes, the S&P 500, the Nasdaq are pulling back, but the bull market is starting to expand. We're starting to see an expansion actually happen. Um, and we're going to go over those charts to show you the expansion that is taking place, right? Now, first, what are the biggest risks right now? The biggest risks are obviously recession, inflation's coming back. We've heard it 1,000 times. But for the most part, where the market is bidding up because those risks are slowly evaporating, right? Those risks are slowly evaporating, and one week we're heading into earnings, and now the S&P 500 and now the Nasdaq actually pull back, and what happens? Everybody gets fearful. Oh my God, I told you this is the top. We're maxed out. We're coming back lower. Maybe this is it. Maybe this is the top. We go back to all-time lows. All-time lows. We go back to the lows, but I don't really see that playing out. And here's why, right? We're starting to actually see the bull market expand. Let me bring this over a little bit. We're starting to see the bull market expand. And if you want to get the market report, if you want to get the macro report, the description is in the link is in the bio or the description. Now, this report is not out yet. As soon as we're done with this broadcast, the report will get released about 30 minutes after. I got to touch it up a little bit. Had a couple technical errors going on there, but you're going to get the report here, and then you're going to get it for free to subscribe so you can read through it yourself, so you can look at those charts yourself if you wanted to. Okay, so the bull market is expanding. What we saw is this past month, right? It's all been a tech rally. It's been Nasdaq, it's been S&P, it's been the magnificent seven: Google, Facebook, Amazon, Apple, Netflix, Nvidia, whatever. Well, guess what? We're starting to see market breadth, right? If we look at the past 1 month performance, we see that small caps in yellow, right? That's the IWM index. Small caps have actually led, right? Dow Jones the value index has actually came in next. The S&P 500 is next, and then tech is last. So what we're seeing is the last month we see more movement, more expansion in the market, not just the magnificent seven, not just the big, tech companies. We're seeing small caps, we're seeing value start to outperform. Okay, so basically, this is not a this is not just a tech recovery, right? I'm sorry. Let me re-say that. Okay, that was a little sloppy. This is the non-tech recovery. This is the non-tech recovery. It's not just tech. So if we break down the S&P 500, let's break it down. What up, Chavez? If we break down the S&P 500 into sectors, the last month of performance, okay, let's look at the last 30 days. What we see is energy leading, financials next, industrials next, real estate next, right? Those are the top four performance sectors over the past 30 days, okay? And technology is actually last. So the market is rotating, right? We're seeing this rotation happen. There is an appetite for risk and and I think the appetite for risk is basically expanding out of big tech and it'll come back into big tech. It'll come back into the magnificent seven or whatever eight you want to call it. It'll come back, but there's a rotation happening because the probability recession is falling, right? The probability recession is falling. And we also see that here in fixed income. So if we look at the last 1 month performance in fixed income, right? HYG at the top here is outperforming government bonds. So just to keep this simple, corporate debt, right? Corporate credit or corporate debt is basically investors investing in U.S. equities or U.S. stocks as far as their debt. So they're okay. That's very confusing. Let's put it this way: corporate credit is an investment vehicle. Okay, you can buy the debt of equities, right? The debt of these U.S. companies, the stock market. You could buy the debt of these companies. You can own that debt because it's going to give you fixed income, right? It's not going to be as volatile. You're not going to get as big of a reward, but you're going to be able to collect some interest the way you do when you buy U.S. Treasury bonds, and you get that interest. The difference is U.S. Treasuries are risk-free. It's the government's debt. They're not going to default where so corporate bonds, right, equity credit, equity risk, they can default. So that's a little more risky. And so that's why that's why when we look at the charts and we see HYG or we see corporate credit outperforming government bonds, government debt, what that's telling us is there's an appetite for risk. There's an appetite for risk, obviously, or else that wouldn't be happening, right? So fixed income, we're seeing an appetite for risk when it comes to that. Now, let's bring it back to the Magnificent Eight. I call it the Magnificent Eight, right? Because we're looking at who's dominating right here. Now, AI should continue dominating the narrative. We obviously see, everybody thought, okay, NVIDIA came out, AMD came out. Who else was it? Google came out with their chatbot. Okay, the AI rally's over. This is the tech bubble, but it's just getting started. Now, Apple comes out with their new AI technology. Now they're talking about generative AI, right? So it's not over yet. We're just getting started here with AI. There's so many different components to the economy that AI can infiltrate and create more productivity, more production, right? At a tenth of a cost. And that is very bullish for the market. The market knows that we're going to continue seeing that. So we will see rotation back into the Magnificent Eight, as I like to say: Microsoft, Apple, Amazon, Google, Facebook, or Meta, Tesla, NVIDIA, Netflix. Why? Well, Microsoft is still the dominant enterprise software network, and they have a chatbot. Apple is the dominant mobile network. You're all stuck on your iPhones. You're going to keep using it. Amazon is the dominant retail and cloud, Amazon AWS network. Google, the dominant, it has cloud too. Google has cloud too, but Google's a dominant information network. Meta is a dominant social network. Tesla the dominant EV, and we might get full self-driving robotics network. NVIDIA is the dominant chips network, and Netflix is the dominant streaming network. So you will get a rotation back in technology, back in a Nasdaq eventually. Which of those are the most likely to fall out of the eight? That's a really good question. I guess I'll answer the questions midstream. So who's most likely to drop out? If I just take a quick look here, I'd have to say possibly Netflix. Possibly Netflix. I mean, maybe because of the whole wokeness, right? Netflix has to change their model. Maybe I'm wrong. Maybe you guys have a different Netflix. I would say Netflix too. Oh yeah, BTC the dominant. We'll go into crypto a little later. We're not talking too much about crypto today, but this all is relative to crypto, because at the end of the day, once we get through it, once we see what the end game is, right? Once we see, we're on YouTube. Once you see what the end game is, then you'll actually know why BTC or why crypto will continue to dominate. All right. So Amazon, cloud network, Google. So I would have to say it's Netflix probably has the weakest stronghold out of the Magnificent Seven. Some people put AMD in there also. So you can make it 9. We kind of switch it around there, but for sure, those are the dominant networks. You could throw Bitcoin in there. You could throw Ethereum in there also. And I'd like to throw Chainlink in there. All right. So back to let me see, per trading view, BTC has been moving upwards in a stair-stepping channel since the cycle lows. Yep, 100%. All right. So yeah, I'm gonna get through the report, and then we'll get to the Q&A. We'll get to the questions. So S&P 500 is retesting, right? Is retesting support. So that's what we're seeing here. Let me see if I can. No, that's as much as I can zoom in. This will be on the report. Like I said, I'm expecting a pullback in the S1. So support level 1, and we go through this Monday through Friday in the live stream, and possibly S2 depending on how good or bad earnings actually come in. Wednesday, keep in mind going forward, Wednesday is the rate decision or rate expectations from the Fed. And then we got mega cap earnings all week, and we're going to look at those mega cap earnings pretty soon. But we are seeing bearish divergence on the RSI, and but we're still holding the moving averages, right? The 50 moving average. So we're in bullish territory, but the S&P is pulling back. A lot of those big tech stocks are in the S&P. And clearly we're seeing a rotation out of tech because Nasdaq sold off the hardest, and we're seeing that rotation into the Dow Industrial Average, or into the value stocks. So we're seeing the rotation happen. It's showing up in the charts, showing up in the price action in investor psychology. 9 days. Now this is from Carson's investment research. A 9-day winning streak. 9-day winning streaks from the Dow tend to happen only in bull markets. So this is just more evidence that we're in a bull market, that this isn't slowing down. And when you get these 9-day winning streaks in the Dow, which we haven't seen for a while, right? The Dow have been underperforming the S&P and Nasdaq, and now we're seeing outperformance. So this usually signals that, hey, we're in the we're in the bull market. Excuse me. All right. So there is also demand for equal weight, S&P equal weight. So if you don't like the big tech, S&P 500, the magnificent eight, as I said, are carrying the market. Well, if we look at S&P 500 equal weight, so you're taking all 500 companies, you're equally weighting them in an index in the basket, that is also starting to outperform. We see volume coming in. We see a lot of demand start to come in the S&P 500. Market breadth is expanding, right? This bull market is expanding. Now, although breadth is expanding, this is really interesting. Although breadth is expanding, and this is where the opportunity lies, big money remains underweight risk. Okay, big money still remains underweight risk. Wall Street is increasing their price targets, although they're net bearish. So we see almost all of Wall Street start to increase their price targets, right, for the S&P 500. They were so bearish from January to July. So 6 months later, they're increasing their end year price targets. Now, they were forced to do this because well, there's a lot of reasons why they were forced to do this, but the whole point is, hey, they're having to reverse course on what they said earlier. Now, if you look at, there's only one company, Cantor Fitzgerald, not one company, there's only one research or whatever you want to call them, major Wall Street firms that have actually lowered their S&P end year target, and that is Cantor Fitzgerald here. They lowered it from 4,100 to 3,500, where Fundstrat actually has new highs on the year. Fundstrat, you guys know Tom Lee, 4,750 to 4,825. So big ranges here, but for the most part, you look at Bank of America, Barclays, Citigroup, Credit Suisse, Deutsche Bank, Goldman Sachs, JP Morgan, Morgan Stanley, they're all changing their price targets. They're all upping their price targets other than Cantor Fitzgerald to the upside, right? Do they know exactly what's going to happen? No, these are just, you take this in stride. This is sentiment starting to change, right? Sentiment having to force, okay, you know what? Maybe we're higher, but we're not going to be that high. So you only have one major firm who's actually revising to new highs. That creates an opportunity if we do get the macro in our favor continue, if earnings start to bottom, if the Fed reverses course and everybody, most people are off sides, if positioning comes right back into the market, right? So there's a lot of opportunity there, and that's sort of what we're looking at. Now, what are the concerns lately? The concerns, right? If we look through April, May, June, July, make sure we can see that. If we look through April, May, June, July, these concerns are starting to shift. Earlier, it was financial stability. Back in April, right? Because we just had the banking crisis in March, the regional banking crisis. Financial stability was one of the biggest concerns. Inflation's been the biggest concern, but financial stability, a fragile financial market, was the concern. Lack of liquidity, or banking risk, deposit risk, whatever it was. Now we go into July, April, May, June, July. Those risks have now shifted into sticky inflation, right? It has shifted to is inflation going to be stickier than it was before? And that's okay. That's good. We want to see these shifting concerns because we know the previous concerns are starting to moderate, right? Those concerns are starting to evaporate. As I like to say, it's a little expressive language there, but I say they're evaporating because people are being surprised to the upside. Things are getting better. So, and we'll go over inflation and what that's sort of looking like. So what about inflation? Now, this is hilarious to me. People don't understand how inflation works. They don't get that inflation has been sticky for a while. So let's kind of go through this. If you look at trueflation, okay, trueflation is 10 million data points on chain, which is why blockchain will be prominent over the next couple of years, over the next 10 years. Blockchain technology, however you like it, maybe you like Bitcoin or crypto or you don't, blockchain technology will be here to stay because of the transparency, because of the units of account, because of it's a better ledger to keep track of stuff. So trueflation has 10 million data points. It's on chain, so everybody can see it publicly. And trueflation shows us that inflation is at 2.13% headline versus the government reporting at 3%. The whole year, trueflation's been lower. Nobody believed it. No, it's a lie. Can't be, right? Unless you believe in it. But so far, it's been correct. So far, it's led us. It's definitely led inflation expectations versus the headline. Now, inflation is not good or bad. Keep this in mind. Inflation is not good or bad. It's a balance. It's a balance, right? As the cost of goods go up, so do wages. So stop complaining. People are complaining, oh my God, inflation's up. My eggs are up. My bread's up. This is up. I can't believe it. The government is evil. Well, bro, your wages are up also, right? If they're not, then get a better job. So this is the system we live in. This is the financial system we lived in, that we've been living in. It was here before you were born. which is inflation is how you build growth. It's how GDP goes higher, and so do wages, right? So stop complaining, do your research, understand how to overcome inflation. It is not complaining, it is not blaming the government. Inflation's always been here because this is the banking system that we live in. You can always point out an item or service that inflates faster than your wages. So everybody points out, oh, well, you know what, this is, my wages haven't gone up as fast as the price of eggs or the price of watermelon or whatever it is, right? And vice versa. Well, guess what? Vice versa means there's also items, there's also goods and services that have also, that your wages have actually exceeded. So you can make that argument either way, right? By the way, rents here in Phoenix are actually falling, right? They were, you know, the average rent was somewhere around 2,200. Now it's at 1,800 6 months later. So rent, there are prices that are falling. You just got to look, right? If you really want to know, as far as economically, as far as the stock market goes, the stock market only cares that CPI goes lower, that the overall CPI makes progress lower, because risk assets in general, that's what they do, they go higher. So the general basket of inflation, inflation is the general basket, not a single item that you point out. It's a general basket of goods and services, right? So if you're the one, now here's the other part. If you're profiting, if you're the one profiting, you wouldn't be complaining. That's the other part too. And I'm just pointing this out because people really don't understand inflation. They think it's prices rising. Well, your wages rising too. So are you complaining about your wages going higher? I don't think so. It's usually because you don't understand something. You want to blame somebody else and not take responsibility for getting a better job or for investing in the first place, right? So if you're the one profiting, you wouldn't be complaining. Welcome to capitalism. It's not fair. It's opportunistic, which is why, right? Which is why we invest, right? So yes, the government can fudge the numbers. People say, oh, well, the government's lying about the numbers. Yes, they can fudge the numbers. That's why we use Trueflation, 10 million data points on chain. Okay. Right. Next, the point is, right, for this whole thing, the reason why we're even doing, the reason why I'm even, not just me, but the reason why this is important is because yes, inflation is with us. It'll always be with us. Sometimes it'll accelerate faster than other times. But the point is for you to invest in assets, because they significantly, if you pick the right assets, you pick the right vehicles, they significantly outpace the inflation of goods and services, right, and wages over time. So that's the point of this, right? So you just, navigating the markets is difficult. It's it's competitive. Yeah, it is. So the next narrative here too. How you guys doing? What up, Bush 18? I don't know who you messed with. Okay. So we're on Bluetooth, by the way, if you want to check out this charts. So next, earnings, right? The next question here for the catalyst for the market to keep going is earnings. Earnings, right? Will earnings bottom in Q2? We've been in an earnings recession, and earnings are kind of shaky right now. They are negative, and we're not done yet. So this is the data we've got so far. So far in Q2, 61% of S&P 500 companies have beaten revenue estimates. Revenue estimates, which is below the 5-year average of 69% and below the 10-year average of 63%. So top line revenue is declining, right in line with GDP. And what that tells us is that yes, revenues, which is the top line, is declining. Well, GDP's been declining, so it makes sense that revenues do decline. Now, the negative part is it's below the 5-year and 10-year average, so it's declining. And that's a risk right there. That's a risk for the market, which is, oh my goodness, we're falling below estimates. And we'll continue to see if that is the case. This chart is just highlighting so far 61% of companies have reported above estimate revenue versus 39% have been below, right? But that's below the averages. We still have big mega cap tech, which I think counts the most. Going forward, we've had Tesla and Netflix so far and a couple other banks, but we still need to get past the rest of earnings to really get a clear picture on what's going on here. All right, so now moving on to EPS. This is an important part here. 75% of S&P 500 companies have beaten EPS estimates below the 5-year average. This is below the 5-year average of 77%, but above the 10-year average of 73%. So still not great. EPS is still lower, right? And we're keeping track of this, but in general, we are still 75% of estimates on the S&P 500 so far. As far as earnings, this matters. These are the fundamentals, right? These are the fundamentals of the market. So this is why this is important, because it kind of tells you where analysts are. Are analysts correct? Are they wrong? And where the real opportunity lies is when everybody's off sides. They're on their position for super negative, very negative, and then we start beating expectations. They get FOMO. They come in, right? I think we're in wave 2 FOMO. This could end though if earnings go bad, right? There's more data from FactSet that show us that so far earnings are actually pretty terrible, and we still have more room to go. But we have the big mega caps coming up, and that's what's next in this line item in this report, which is keeping in mind first. Yes, revenue is declining right in line with GDP, but the story is about the bottom line, right? You got top line, you got bottom line revenue, and the story is about the bottom line. We know earnings are going to be negative. We know GDP is coming down. So can you retain your earnings, right? Can S&P 500 companies retain earnings while the business cycle bottoms out and turns up? The business cycle as in policy, economics, economic growth. It is slowing, inflation getting back down, and everything start turning back. So as things slow, as we're slowing down, can earnings hold on to can they retain earnings, right? Which means they have to cut cost, just like you as a consumer. If you really want to beat inflation, guess what? Get a better job, make more money. Okay, it takes time and spend less. That's exactly how it is for S&P 500 companies. Can they get a better job? Not exactly. They can invest more, but they can cut costs to save on their earnings, to retain those earnings they're actually pulling in. And that's what's important. So next week, big mega cap earnings. These are going to be the most important for the week coming up. Google on Tuesday, Microsoft on Tuesday, Visa on Tuesday. Wednesday, we got Meta, Chipotle. You guys love Chipotle, Boeing, and Industrial. Industrials are doing pretty good. Thursday, we got McDonald's, Intel, and Honeywell. Okay, so again, this will be in the macro report, or you could just look it up online. What are the most important companies for earnings coming up next? All right, so next segment. The economy is flirting with recession. We know that we are flirting with a recession. This is becoming the fuel to the downside, right? This is where people are a little negative, where they're worried, and it makes sense. They are worried. So the economy is worried about a recession. The economy is flirting with the recession. And the heart of the story, I believe, is that we are actually in a rolling recession. So we're seeing disinflation. We know inflation is coming down. We know inflation is coming down. We've seen headlines, CP, PCE, right? Core is a little sticky, but we know shelter is going to come in lower. But that also means the economy is slowing down, right? So we got to keep track of that. So what this chart is here are these couple charts are is business activity. These are leading economic indicators. So these tell us what is ahead, what is to come. And we're seeing more recession territory for the manufacturing sector. Remember, the economy is made up of two sectors, manufacturing and services. Services is about 70%, which we'll see coming up here. But the manufacturing sector is still signaling recession. But the question is it getting worse or is it starting to recover? So New York Empire Manufacturing Index, it got above zero, but it's, it looks like it's still weak. US Philly Fed Manufacturing, this is in the Philadelphia region, still negative. Maybe it's bouncing. Who knows? We'll keep track of that. Now, this is one signal that we haven't seen since the pandemic, and that is industrial production for the first time turns negative. It actually went negative. This is bad. This is not a good sign. So, I'm not hyper bullish, we're going higher no matter what. There's some negative signs here. I just think if you look forward psychologically, what have we seen? We've seen stimulus come in to protect this downside growth for the most part. But we are entering recession territory when it comes to industrial production, which is a forward-looking growth indicator for the market. So we're in a rolling recession. This means economic weakness continues to spread, right? Manufacturing has been in weakness, has been in recession territory. Goods have been in recession territory. Housing has been in recession territory. Retailers, we saw retail sales in recession territory, and that'll likely roll into commercial real estate because we know there's some risks there, right? But here's the good part about this disinflation or about this slowing economy in the manufacturing sector. The good part is you can't generate inflation. People get mistaken by this. You can't generate more inflation as in re-accelerating inflation in a slowing environment, right? You're not going to regenerate inflation as you might hear in the headlines or from these bears or these people who just want more inflation. You can't generate inflation unless growth starts to re-accelerate. And you can in one instance, and that is if the supply chains actually break down. But that's not the case. Supply chains are strong. We're seeing that. That's not happening. So GDP is cooling slowly. Perfect scenario for inflation, right? The GDP recession happened back in 2022. We had 2 quarters of negative GDP. Yes, that is a technical recession. The market didn't bounce till later. And now we're slowing, right? We're at 2.5, 3. We were at 3.25, 2.6. Now we're at 2%. So we're slowly coming lower, right? Whether we go negative or not, we're going to keep track of on a week over week, month over month basis. But so far we're cooling, and that's okay. But it may be bottoming, and that's kind of what I'm seeing here when I look at the economics is I think we're actually starting to bottom in GDP in the overall economy, and this is driven by services. Services make up 70% of the economy. So if we look at GDP year over year, the trend is showing us a bottoming, right? The trend is actually showing. Now, is that a fact? No, it's just it is just looking at the math, looking at the statistics that could change wildly over time. But we're looking at the details here. If we look at ISM, services versus manufacturing, so this is a chart of services versus manufacturing and GDP. And remember, there's two types of economies. These are the leading economic indicators for those two economies, which is manufacturing, goods, and services. Services actually bounced, right? So services bounced higher. We're still holding above trend. I'm sorry, expansion territory. So I think services are holding up the economy. GDP may turn up. We'll see. It's still lagging. It is the most lagging growth indicator. While manufacturing takes a dump. Manufacturing is negative. Manufacturing looks like it's taking us into a deep recession. Okay, but that actually could be turning here, right? And when we look deeper into manufacturing, the business cycle in general, there are a couple signals that tell us maybe we are starting to pick up, right? ISM new orders. So new orders in the business activity in the manufacturing sector is actually starting to pick up and maybe bottoming out here. So we're seeing new orders start to come in. Inventories are also dropping. Employment is picking up a little bit, right? So there is some strength. We could be bottoming. And this is just a micro detail. It doesn't mean we are. If we look at durable good orders, right, those are also starting to bottom. So durable good orders and ISM or manufacturing orders are starting to pick up. So maybe the goods recession is bottoming out. It's not going to shoot straight up unless the government gives us direct money, but it is starting to bottom out. And we're seeing that. Okay, looking at the housing market, right? Remember, we're in a slowing, cooling environment here, but we're not collapsing. So the housing market, real estate, is not strong, but it's also not weakening. Okay, I guess you could say it is weakening on a year-over-year basis, but it's not collapsing. So we look at existing home sales, right? They popped a little bit this year. After decelerating heavily, we're still in recession territory for existing home sales, but they're starting to bottom out, right? They're slowly, coming up, trickling lower. So the slowness is good because it keeps inflation at a halt. It tells you we're not going to see inflation going forward. I think it actually collapses, and the Fed is actually going to overshoot inflation to the downside, right? And there's tools that could actually bring us out of that. So we're recovering. So we're still not in a recession. Now, last week we said, hey, look, the housing market looks like it's bottoming. We're looking at housing starts. So new contracts are building permits in general for real estate, and they're bottoming out. They've been bottoming out. Maybe they stay in recession territory down here, right? They're still bottoming, but they're not plunging lower. They're definitely not plunging lower. And that is the upside for the market, because what it means is, okay, prices will still fall in real estate, in housing. They'll still continue to fall in some areas. Maybe they're not in others, but there is weakness. Therefore, the Fed is not going to continue to tighten. Therefore, financial conditions can start to recover. Okay. Now on the upside, right? We're not on the upside. Home builder sentiment is slowly expanding. And that suggests like home builder sentiment. So home builders are still building, and that suggests to us, because they're looking at all the data, they're the ones who decide should we build or not. And they are building. They're getting more excited about it for some reason, right? And I think because there's a lot of cash on the sideline, there's still a lot of demand for homes. I don't know exactly the answers. I don't have all the answers, but we are looking at the sentiment surveys, and sentiment is very important. So it looks like we are slowly starting to recover there. Okay. Now, next segment. The market, I think, is looking past. I think the market is basically looking past this hiking cycle. Okay, I know rates are elevated, but we got to think a little deeper on this. The market's always front run what people expect, and the economists. If the economists were right, they'd be rich. They wouldn't be economists. They would just be rich. They would guess. It's hard to guess the stock market for a reason. And so let's look at the details here today, right? This is a chart of basically. This is really difficult, right? I might lose you here. You might want to close your eyes. You might want to go, do something else, because you're going to have to think on this one. And this is what this is here. This is, let me read the headline. Today, rate expectations in pink. Okay, so this is interest rate expectations. This is the Fed saying where they want to go with their terminal rate. This is basically where the Fed tells the market, hey, we're going to bring rates to this level. Okay. So that's pink. That is the rate expectations. That's what the Fed communicates to the market. Are much higher, right? We're much higher than we were back in 2022 in March, and the same time, March, April, May, or the beginning of the summer. This was the beginning of the summer down here, right? So now we're much higher than we were, although financial conditions in black, right? This trend in black, financial conditions, which is how tight, how tight conditions are for risk, for investment, are actually at the same level. So what that means is we're essentially seeing higher rate expectations lead to more accommodative conditions. So even though rate expectations have gone up over the past year, the conditions for investing have actually loosened. They've eased on us, which is probably why the stock market is still going up, right? And it looks like we peaked in financial conditions back in October because we got more liquidity, inflation peaked. Interest rates went up, but liquidity came into the market and inflation peaked. And that's the biggest factor, is that inflation is a haircut on your earnings. Inflation really hurts business and hurts corporate earnings, but inflation, it actually helps corporate earnings in some sectors, in some areas, but inflation's coming down. Those pressures are starting to come down and starting to evaporate. So what I'm really saying here is that the market is looking past the hiking cycle because they're seeing that financial conditions are starting to ease, and that's optimistic, right? Also, if we look at this survey, right, the Fed is becoming more dovish and more optimistic despite holding rates higher. So again, you're gonna have to think here on this chart. What this is in black, we have the Fed funds rate, right? This is the tightening cycle, the Fed tightening rates at the fastest pace in history. That's what we've seen. In red, we have the Fed's hawkish tone, right? This is the Fed's hawkish tone. This is how, and basically this is taking the language of the Fed, how hawkish they are, and that hawkish tone peaked and is now coming down. They're becoming more dovish, right? They're actually becoming more dovish in their language. At the same time, Fed optimism, so how optimistic they are on the economy, is starting to rise. So we're seeing a divergence here, which is, yes, rates are higher, they're holding them higher, they're going up, but they're slowing down at their pace. The Fed is becoming more dovish to ease conditions and more optimistic around the corner, and the market sees that, and the market is moving higher. Okay, so the yield curve, right? This is going to be very, people aren't going to like this, but the yield curve inversion, this is the reason why the market's going lower. Now, the yield curve is basically, you take how can I make this simplify this? The yield curve always signals recession most of the time. It's signaling that something is probably going to break. So if we look at the past yield curve, so this is basically some from trade analysis, right? And this is just looking at some data here. The prior what he's saying here is here down in the green, 3 recessions in 1980, 82, and 1990 with the yield curve inverting saw the S&P actually move higher. All right. So the yield curve inverted, and then, after it started to steepen back up, in red is the yield curve, the S&P moved higher. It inverted, and then it came back up and the S&P moved higher, right? Same thing in 1990, the yield curve inverted, and then the S&P moved higher over a longer term trend. Obviously, we're not talking about a month or a week. We're talking over the long period of time. Now, the last 2 times that this is called what is it called? Prior bias or previous market bias, right? So when we saw the 2008 financial crisis in 2001, that actually didn't happen. The yield curve inverted in both those instances. The yield curve inverted and the market sold off, right? In 2001 and in 2008. So that's what's in investors' mind is 2008 and 2001. Hey, maybe fair enough. Maybe we do sell off. But I think the difference is where price was, right? Price was coming from a bottom back in the times at the end, the yield curve inverted and then went back positive, and the market went higher. It's because the market was coming from a low. This is positioning. People were offsides. They were positioned for negative, and they started adding back risk when things abated, right? But in 2008, 2001, we were at all-time highs when the yield curve started to invert. So people are saying, "Oh my gosh, we're overvalued. Something's wrong. Let's, things sold off." So it's just kind of more market psychology is what they're pointing out here. So the question becomes, is this a green square or a red square, right? Basically, is this a recovery from the inversion, or are we going to sell off back into all-time lows? And I would say this, the yield curve was negative and something did break, the banking crisis in March, and the Fed stepped right in, right? Bank Term Funding Program, emergency lending facility. That's what we got. We also have at the same time, the White House pumping a lot of government spending. They're spending a lot. So that's supporting the economy, while the actual pipelines in the financial sector, the regional banks, they were resolved through the Bank Term Funding Program, right? Emergency lending. So that's why I think the yield curve isn't really giving us a clear signal, or it did give us a clear signal, and maybe it does further, but it didn't really work. It didn't signal or so far it signaled weakness, and the Fed stepped in, period, right? The Fed stepped in. Next risk to the market that people are worried about, right? This one's a little more difficult. It is the basically, the federal, I'm sorry, the US Treasury needs to sell more bonds. They have to create more debt, and that debt has to be bought up by the banking sector, so it's going to drain liquidity. So really what's happening here on this is the RRP is a reverse repo facility. This is basically the Fed savings account. I just want to make this simple for people who are watching this. For the last 2 years, 3 years, there's a thing called the reverse repo facility, and it's collected a lot of cash. It got up to $2.5 trillion of cash. So cash, think of tightening, cash left the economy, cash left the capital markets and went into the Fed's savings account, you could call it, right? And they pay interest to people who park their money there. So that savings account went up. So you have $2 trillion of savings, and at some point, this cash is going to be deployed back into the market, and we're starting to see that actually happen. This cash is rolling over. You see it coming down. This chart coming down is signaling that the savings, the cash inside the Fed, is leaving the Fed. It's dropping, and it's going somewhere. It's going in the banking sector. It's going to the U.S. Treasury. It's going to the capital markets, right? And also coinciding with that is basically the U.S. Treasury spending account, or the TGA, and they call this the TGA drain. The TGA, if we just look at the correlation, the U.S. spending account has actually went up, so they're filling the coffers. The bank account of the U.S. Treasury has gone up, while the Fed savings account has went down. So it looks like cash just left the Fed, went into the government, QE, right? QE, regardless of what you think of it, they don't call it QT or QE. They say we're in QT, but yet that reverse repo facility, that Fed savings account, that cash at the Fed is leaving the Fed, and it's going somewhere. The market's going up, and the U.S. spending account has just went a lot higher. Okay, it's also taken from the bond market, but it's not that big of a risk. Whew, a lot of talking there. Okay, next big risk, and we'll get to the questions, we'll get to the comments. Government household debt, right? I saw this chart, and basically what it is home buyer, right? Debt to income ratio. The debt to income ratio is averaging close to 40% in 2023. Those are near the worst affordable levels on record, according to the FHFA. And my calculations even worse than the 2006, 2007 bubble before the crash. So basically, debt to income ratios for home buyers is getting worse, right? That there's more debt than there is income. Last time we saw this, the bubble burst. That was the housing bubble. So are we going to get another housing bubble, right? People are worried about this. Is there going to be a huge crash? And that's it's understandable. That's something that you definitely want to worry about, or that you definitely have concern for, right? So people may be paying more interest that goes to, and what it means is consumers, they're going to be paying so much debt on their housing, right, because of the interest payments, that there goes growth. They stop spending in the economy. They stop traveling. They stop doing this. My argument is, if interest rates come down, it doesn't matter. If interest rates finally fall, then their rates will be lower. They're going to keep spending. As long as they have a job, they're going to keep accumulating debt, just like the government. Okay. So the next risk here also is government interest payments, right? U.S. interest payments on federal debt versus spending. So we talk about this all the time. It's a really complicated subject, but what this basically signals here is the annual interest payments for the government, right? The annual interest payments are over $900 billion, or about $900 billion. And that exceeds, so your interest payments are exceeding your spending, your defense spending, okay? So as an example, imagine your credit card bill exceeds your mortgage payment, right? Exceeds it. Now, that's not the best scenario. That might not be the best analogy, but the point here is that interest payments are surging so high. There's so much for the government that they're going to eat from growth. They're going to take from real GDP at some point, because you can't keep this up. You just can't keep this up, which is, okay, how are they going to keep paying for the debt? How are they going to keep paying for this debt? Well, there's one answer to that, and that is more stimulus at some point, right? And that's going to go on the Fed's balance sheet, as it has in the past. So, and this is kind of the answer to all that, right? This can't continue. We know that. How people's debt in their homes can't continue. Interest rates have to come down. That's the thing. Interest rates are going to have to come down for home buyers, not to have another housing crash. You got to get the interest rates down. Okay. Now, for the U.S. Treasury, or for the government, the interest rates have to come down at some point. The interest will need to come out of GDP, or the Fed will have to cut rates, reduce the payments, or start printing again. And this is really the business cycle. This is well, forget that dollar weakness. Let's take a look at this. This is the business cycle. We see this all the time. And the great financial crisis, what we had is after the crisis, in white, liquidity. This is liquidity versus interest rates. The 2 year, you got 2 year rates here. You had a surge in liquidity, right? After the great financial crisis, surge in liquidity, and rates came lower, right? So that was the beginning of the business cycle. That was the end of the debt cycle and the beginning of the the downside of the cycle and the upswing on liquidity. And liquidity is if you lower interest, well, there's more liquidity in the market. If you pump liquidity, there's more liquidity in the market. So when you get these two things conversing, liquidity up, rates down, that is the beginning of a new cycle. Okay. During the pandemic, we had the same thing. Interest rates basically went to zero after GFC, and they started to hike back up. This is the bond market. After the pandemic, rates sold off first, or bonds got bid up because the growth was collapsing. So you bought more bonds, interest came down, and then finally you got liquidity. So what we're kind of looking at here is we're seeing the great deflation. Inflation may be the concern today for people, but eventually it's going to turn into deflation, which means prices start to decelerate. And if that is the case, a lot of growth also starts to decelerate. So the only way to save, the only way to get out of the debt bubble is to print or to take the government debt and put it on the Fed's balance sheet for the Fed to actually buy up all that debt. And we should see the Fed's balance sheet go up. And that's what this liquidity marker is here, is the Fed's balance sheet. So far, it has been going lower, but at some point, we're going to keep our eye on the Fed's balance sheet, because as growth decelerates, they're going to have to do two things. They're not going to just let the economy collapse. As long as inflation keeps showing progress, as long as we get inflation lower and we head into deflation, we're going to see the Fed's balance sheet start to turn back up at some point, right? Or we'll start to see rates come down through the bond market and then through the Fed funds rate. And really, like, jumping over to the charts, I mean, we'll look at that. Global liquidity has also been turning up, and that kind of takes care of the growth situation, is global liquidity. And that brings us to the last chart here. I believe this is the last chart. Yeah, I think this is the last chart here. Ooh, that's a lot. Okay, dollar weakness. Dollar weakness is risk on. Okay, the dollar broke a level, and now it's coming back up to retest that level, that 101 level. And really, when I'm talking about liquidity here, the business cycle, the dollar really kicks off the business cycle. The dollar is the answer to pretty much everything. Okay, I'm going to try to expand this here. I'm actually going to remove myself to the lower angle, because I want you guys to see this, right? I want you guys to see this. And this is basically, the dollar always signals more liquidity. And I think we're looking at the dollar start to break down here. So I'm going to zoom in. The dollar's starting to break down. If this continues, this is really the front running signal that, hey, the economic cycle or the liquidity cycle should start up again, because global currencies around the world, they can strengthen. Therefore, they have more demand. They have stronger currencies. They feel richer, and you get more liquidity on a global scale. So first, I'm going to remove global liquidity, and I'm going to look at the Fed's balance sheet. Just about every time. So let's go back in time. Let's do some history here. The last time the dollar, right, this was 2008, right? This is the great GFC. This was the great financial crisis. When the financial crisis happened, right, first the dollar surged primarily because it's risk off, right? Everything fell apart. That's risk off. But as the Fed started pumping liquidity to save the markets and drop rates to zero, you saw the dollar, come off. And that's the sign of liquidity coming into the market. So the dollar came off. Liquidity rose. Now liquidity front ran the dollar, but on the second part, the dollar sold off and liquidity continued higher, right? This third part, this is 2012. The dollar kind of moved sideways, but for the most part, it was trending lower, and liquidity continued to rise, right? Continue to rise. This is the Fed's balance sheet. It's not a perfect correlation, but what we're looking at here is when we have these big changes in the dollar, or these big changes in liquidity, they coincided with each other inversely for the most part. The dollar surged, and this was 2015. The dollar surged higher. Liquidity was flat, right? Liquidity was pretty flat. The dollar strengthened. Okay. Now we come into 2016, 2017, the dollar broke down. The dollar, this was a sharp sell-off in the dollar. And that kind of signaled, okay, liquidity should come back. It was flat here. Now we didn't get Fed liquidity, but during this whole sell-off on the dollar, this was actually fiscal liquidity, which we are getting right now. Fiscal liquidity. This was the tax cuts that we got, right? So there was some type of liquidity coming into the market. Okay. Now, next, the pandemic, we had the dollar peak and the dollar sell-off coinciding with more Fed liquidity. So when we look at the backdrop here, what we're seeing is if the dollar keeps selling off, it is kind of signaling that at some point that Fed liquidity is going to have to come back into the market, because the dollar is not going to surge, or the dollar is not going to go lower unless they debase the currency fully. That's how the dollar goes lower, is they start debasing the currency. And we already got some of that back here when we got the bank term funding program that kind of kicked off the S&P again. So at some point, as growth slows, as we head into these debt cycles where things are going to blow up, the Fed will step in just like they did before, and we should see the dollar crack even lower, really signaling that this cycle is starting to end. Okay. Now, if you want to take the Fed's balance sheet off, that's fine, and say it doesn't correlate that great. Well, we'll go to global liquidity. We'll take a look at global liquidity and global liquidity. So we're looking at the G4 or G5 central banks around the world. It's pretty similar. It is pretty similar, right? And it's the same thing. You get the dollar weakening and you get liquidity moving higher. Normally, liquidity will just keep moving higher, but the thing here is that when other economies start to weaken, their central banks print money, our central bank prints money, and the dollar just continues to weaken. It's not going to strengthen unless our central banks are increasing rates, right? That's usually the case. So like I said, it's not a perfect correlation, but when the dollar surges, you see global liquidity pretty flat, right? Didn't really move up much. And then it started to bump up here, right? I know this is probably not the best way to introduce this chart, but you saw liquidity pick up when the dollar did weaken, okay? And again here, global liquidity picks up, the dollar weakens. And this is kind of the regime we're in. This is the last 5-6 years. So I'm going to prioritize like an EMA, right? More closer to the previous levels or the previous time that we're in, because the central banks, their operations are going to be more similar, in the last 5 years than they were the last 50 years, because just the whole banking sector is different than it was, right? It's a lot different. QE didn't start till 2008. So here, this was the pandemic, right? Things fell apart. Global liquidity shot up. The dollar shot down. This was the start of the new bull market, right? This was the great rebound if you caught the bottom, right? That was pretty tough. So now global liquidity is down. It's starting to bounce, right? I think it goes higher. And right now we're seeing this inverse correlation between the dollar and liquidity. Okay, yeah, that's really confusing. I don't know the best way to explain it, but I just want it to be on your radar, which is if we see this global liquidity keep picking up, it should coincide with the dollar dropping, which means there's more liquidity coming into the market. It also means the S&P 500, the crypto, whatever it is, money is moving from the dollar into these assets. It's starting to get reinvested. So, hey, who knows? Maybe it's kind of wooey and whatever you want to call it. But for the most part, these correlations are pretty sharp. When the dollar sells off sharply, global liquidity is usually moving up. And that's kind of what I want to leave you with at that point, right? I want to leave us with that. So that's kind of the case. That's what we're looking at here. I think the market is muddling around, but at some point, that those interest payments will collapse everything, and you're going to need global liquidity. You're going to need liquidity to come back in, and it just comes down to inflation continuing to make more progress. All right, so let's take a look here at the what up, Bukowski? Take a look at oil after. Yeah, you're right. Oil is the big risk here. I don't have it in the macroeconomic report, but oil is the big risk. So looking at the charts, this is probably the biggest risk on my radar. Oil is at 77, right? It is breaking out of this downtrend, and that's sort of the worry here, is that we break out of this downtrend, because what that does is it brings energy costs up. And even though shelter is decelerating, even though shelter costs will roll over, this is more immediate. Oil prices immediately price into CPI. So wherever the oil price is moving up, that's going to be that's going to factor into the next month's CPI. So here coming up the next inflation print in August, if let's say the oil prices just cap out here and move sideways, well, CPI might be kind of flat. It might stay at 2.8, 2.7%. I still think it comes down because it's the rate of change, right? If oil stays at 77 for 2 months, well, it didn't inflate. Therefore, inflation comes down. Inflation is not measuring the absolute price. It is measuring the gain or the changes in price. So if price stays the same, that's lower inflation, period. That's lower inflation if price is the same. It's mathematical. and you either you get it or you don't, right? But if oil surges, if we start to surge in oil, well, that's going to bring inflation higher because the rate of change of energy prices are going to go up, and that factors into a lot of stuff, including, including oil. Oil is a big portion of the economy, so let's just put it that way. Oil needs to stay lower. This is the big risk off chart if it surges higher. Hopefully, we could stay beneath this big level at 83.50 if we do go up, then the market might, you got to factor in that turbulence into the market. But for now, we're just keeping our eye on that. So you're right. That's something to look at. Also, the dollar. Yeah, we sort of looked at the dollar. The only good thing would be that the dollar surges, not surges, the dollar moves up sharply and knocks oil down. But right now, we're not seeing that. If the dollar rolls over, it actually could fuel oil prices higher, right? Just as a correlation, it might fuel oil prices higher. So I am worried. I think oil has a chance to move up to 83. And if that's the case, like looking on the daily chart, if that's the case, then it could be a little more turbulent, and we do get the end of the summer sideways action in the market. I think it pressures the market to move sideways and not higher, right? Does it cause the market to sell off completely? No, because in general, producer prices are coming down. If earnings start to bottom, we're going to be okay. So this is still the big risk to inflation, because if inflation reemerges or reaccelerates, then that's it. We're definitely going to sell off in all markets. So keep your eye on this oil price getting to 82.50, getting to 83. That's what I would say. Anything else? Any questions that we got here? That's probably a bot. Yeah. Be careful. There's people impersonating me, so those usually are not me. If you're getting a message, people create a fake profile all the time. Whew. Okay. So anyways, yeah, this macro report will come out today. By the time we're done streaming here, I'll send that report out. But I think the biggest factor here is that we are headed into earnings, and earnings are not the best. So actually, we just got some more news on earnings today from FactSet, showing that. And I'm going to read through this article. I'll get through this article and I'll send it out. But it's basically showing us that. Oh no, we don't have to go through the article. It's right here. All right. So S&P 500 earnings growth for Q2 so far. Right. These are the expectations. Look at my mouse. The expectations for the S&P 500 are supposed to be -7%. So far, all the reports we're at -9%. This is not good. This is not good. Maybe it is. I don't know. You never know. But if earnings are worse, if they come out worse than expected, expect a big pullback in the S&P 500. Expect some downside. But we haven't got we haven't finished with big tech. We still need Microsoft, Apple, Amazon, Google, Meta. We still need the big mega cap earnings to come in, and maybe industrials, maybe consumer staples. People are spending in the services sector, so the airlines should do pretty good. Manufacturing, maybe not so. So we got to wait for the rest of the earnings in. But I'm not going to lie to you guys and say, oh, earnings are great. No, they're not looking great. Expectations are beating in some areas, but they're not looking great so far. And we will keep up to date with this. Bukowski, do you think this dip will be a little bigger? We'll look at the actual technicals of S&P 500. Here's where I see us coming down to, right? If we do dip lower, maybe 4,400, and then possibly back to 43.2, right? That's really going to come down to the earnings. But I don't think the bull market ends if earnings are weak. I don't think so, because overall we know that we're getting closer to the end of the hiking cycle. GDP is slowly coming down. I mean, there's other factors. There's a lot of stuff to balance here. So I'm not going to say we know for sure, but if earnings come in better than feared, better than expected, as they did last quarter, then I think, we find a bottom and we rotate a little higher. We go higher, right? The biggest pullback possibly is, we see we're at a 40. I think at the most we pull back 5%. That's what I think. 432 in the SPY. 432. Maybe we pull back really hard. That'll cause a buying opportunity, because remember, people are offsides. People are underinvested. They're not invested all the way. They're underinvested. We see that with the institutions, and they're going to buy that dip if they see upside. And by the way, Netflix beat earnings. Their subscriber count got better. Tesla beat top line and bottom line and margins. So really, the market just ran up really quick, really fast, and there needs to be a relief correction, and it's healthy to get that correction. So the correction is good. It's not terrible. It's good. A rollover in the trend would be bad, but we're just getting a correction, and that sets up for that sets up for those institutions or those buyers to start stepping in again. And that's what I expect. The worst thing would be that oil starts to surge over 83.50. Then we have some turbulence, because then inflation, the inflation progress kind of gets erased. I'm underinvested also. Yeah, most people are underinvested. They are. So when you see that pullback in S&P 500, you're going to say, maybe we can pull back further. But if it doesn't happen, right, if we don't pull back further, we start to consolidate and create a bottom. Well, people are going to come into that. If you add on top of that earnings coming in, showing it bottoming, this is supposed to be the worst quarter of earnings. We are looking at the worst earnings quarter. If this is the worst earnings quarter and it comes in, it comes in and starts to bottom and guidance goes up, we're really going to be listening for guidance. If guidance is up, then hey, that's it. Like, investors are going to be pretty optimistic, right? They're optimistic about the Fed already. The Fed's getting a little more dovish. The reverse repo liquidity is coming back into capital markets, filling up the bond market. If bonds start to reverse, this is another thing that I think is pretty bullish, is that this 10-year, not 10-year, but the bond yields in general, there's a huge short squeeze that could happen if the economy keeps worsening, right? If inflation comes down to 2% and collapses, these bonds are going to come lower. That's going to fuel asset prices, because what it does is it essentially increases your earnings expectations, right? So I still think there's more upside here, because if the economy does start to collapse or some things go wrong, just like it did back here, right? This kind of fueled the S&P. If you guys remember the banking crisis, okay, this was the banking crisis for interest rates, right? For the bond market rates. As soon as the banking crisis happened and there was all that fear, yields collapsed, interest rates and essentially collapsed. What that does is, if rates are lower, well, then you're paying less interest to borrow money. Therefore, your earnings, your margins improve, right? Now they went right back up, which is why it's kind of tightening financial conditions. But if something does break again, which is very possible, and or growth just keeps slowing, these yields will come down, and that'll also help earnings. So I think we're really in a bottoming period. Now, does S&P to QQQ, right? Let's look at QQQ. Does S&P QQ does the S&P or Qs go straight up? No, probably not. But for the most part, there's enough catalysts, especially looking at the Fed, that suggest, in my view anyways, that if we do pull back, if we do correct, we just, we move sideways, and there's enough buyers to step in, because inflation is making progress, because those yields come down and help margins, right? So interest rates being elevated helps on the back half, because they can only go lower from here, right? They're not just going to surge higher unless inflation does. So if they come lower, well, that's going to help earnings, that's going to help margins, and you get another bid, or you get another variable underlying growth. You get another variable setting up or holding growth up. Okay. So you need a black swan. I've been saying this. You need a black swan to really end this bull market. And hey, it's possible. Anything is possible, but I don't think you want to bet on that. So inflation's coming lower, and I think that's the best catalyst that we have. A lot of people underinvested, right? So that's what we have there. Now, Tesla, some of you guys that like Tesla, Tesla pulled back pretty sharply, and I see buyers coming back in here because the FSD, right? They're talking with somebody to license FSD, which would pump margins incredibly. You're really still, like, if we do bottom here, you're still in an uptrend, right? You're still seeing the uptrend happen. It's not the best price action here for Tesla. It definitely isn't not for Tesla. It's not the best price action technically, but it is still an uptrend, right? And when there's a lot of FOMO, a lot of momentum to the upside, we can still move higher. We can still move higher, but we're in a relief period, right? People are, they've made a lot of gains. Just keep that in mind. People have made a lot of gains here. What up, football legends? People have made a lot of gains, and they're booking their gains, right? They're taking their profits. They've made a lot. Things are going up. They've went up a lot. Nvidia, Microsoft, Apple, Amazon, Google, they're taking their gains, and we see equal weight moving higher, right? So no matter what I think, no matter how confident I am in the market, the price is always right. Prices are always correct. They're looking for, the market is much smarter than us, and we see equal weight moving higher. We see the Dow Jones Industrial Average moving higher. So if anything, people are booking profits and they're reinvesting them somewhere else, right? Pretty clear the bull market is still on. They're just reinvesting it. And if this keeps happening, IWM, Dow, then they're going to make gains in those indexes. right, in those individual companies, and then they're going to book their gains and rotate back into tech. So, the only real threat here, volatility is coming lower, is really just oil prices, right? Will oil prices stay tamed? I am worried about that. That is a concern. If oil prices surge up, there's an issue there because the Fed will have to keep tightening. They'll have to break something for sure, because you need those prices lower. Or maybe Biden comes out and keeps draining the SPR at a faster rate. Don't bet on that, but you definitely need oil to stay tamed. We need oil to stay below 85 for this rally to continue. Okay. And, on the upside, shelter prices are falling. So if they keep falling and they factor in CPI, that could cause cause a slide to the downside and help with inflation. And then it's just up to oil. But as the economy slows, like if you're like, oh, we're going into a deep recession, we're slowing down, that is more likely in my view, because the manufacturing is still negative. If that's the case, then oil will not keep moving up because you're getting a slowdown in manufacturing, right? That's the big factor. That's the big factor that causes oil or keeps oil from moving higher, because manufacturing is slow. It's slowing down. So just keep that in mind there. Crypto. All right, Bitcoin still consolidating, still at that level. Still the same story here, right? Which is, regulation may be improving, and that's going to help crypto in general. And the BlackRock ETF, that is the biggest catalyst by far, is an ETF getting passed. Because if something does break in the economy, last time it did break, we saw Bitcoin surge. Okay, if something does break in the economy, the Fed will cut rates. They'll have to cut rates, and the balance sheet goes up, or both. Well, Bitcoin, outperforms in that type of environment. We need to base the currency. That's where crypto performs. So, Bitcoin's going to be, and then if you get that ETF, well, you really get performance, right? If you get the ETF coming in. So you got to keep that in mind. Chainlink, CCIP was released, which is connecting all central banks. Not really all central banks, but Chainlink. And check this out for you crypto guys. Chainlink is looking nice, man. Right back to the top of the trend, off some very solid news, right? CCIP is finally released, and you're basically, in simple terms, CCIP is cross-chain interoperability. You're linking all the blockchains together. The Web3, the idea of Web3 is coming online. The idea of DeFi connecting together is going to happen through CCIP, through Chainlink. The idea of the financial system, or TradFi, connecting with DeFi, decentralized finance, is actually happening through this protocol, and it's actually being used by central banks, by Swift network, right? The Swift central banking messaging system is using Chainlink, using Chainlink as a use case to connect, to interoperate with other central banks, with other messaging systems, for more efficiency, cheaper prices, more transparency, using the oracles. Even FedNow, right? There's some talk about using not Chainlink, but using oracles in the FedNow, in the central bank digital currencies. So either way, they win. And I know a lot of people think, oh, well, that's evil. We can't have crypto merging with central banks. Well, it's a technology, right? Just like AI, just like electric vehicles, just like any other technology, the internet, everybody's going to use it. It's not just going to happen the way you think it is. It's going to, we get surprises. We learn new things. So the Oracle network, if you understand it, it does protect you, because it is very transparent. So it brings transparency to the space more than anything. What else we got here? Yeah, so that's all we got. If we don't have any further questions, we're going to end it here, and then I'll send out the newsletter. I'll send the newsletter out. Let's see any other technicals. So I see Tesla. Tesla looks good. It looks primed. Oh, that's what I was going to say. Looking at Chainlink also. I'm keeping my eye here, and I'll keep this throughout the stream, throughout the week, which is the price of Chainlink versus Bitcoin, right? So Link to BTC, that's going to be important, because you're going to see, dominance from Link. Can it go any higher, or is it going to stick down here? Obviously, the Bitcoin maxis are like, no, that'll never come back up. So we're keeping our eye on this, and it's still in a downtrend. We actually need to move this to a log chart. It's still in a downtrend, but if it breaks out, then you're seeing Link dominance take hold. And really, Link has had dominance all the way till the pandemic, right? Till after the pandemic, that's when it kind of peaked out when it came to Bitcoin. Now Link to ETH also is starting to bottom out. So Link versus Ethereum. So this is just altcoin stuff, right? And then we also will keep our eye on the overall altcoin cycle, which we look through total. Where is it at? This is BTC total Link. Here it is. So this is the total crypto market, right? This is total crypto. And it's trending higher, right? We're above the moving averages. And this is the total altcoin market. So this is the more explosive, risky market here, total altcoins. And really the signal here is when this starts moving up, then you know it's altcoin season. The breakout of this is when altcoins start to fire up. And then you see Bitcoin dominance come back down. So when you see the coincision of Bitcoin dominance come down, and then total 3, which is altcoins move up, and this is minus Ethereum minus Bitcoin, then that's when you know the altcoin season is back, the altcoin summer. And that's when things really move a lot, right? Now, there's some risky assets out there, there's some risky projects, but we like Chainlink, so we're going to keep our eye on that. Small correction. Yeah, small little correction. All right, well, if we don't have any other questions, then we'll end it there. Keep your eye out. Remember, we have a fitness stream today we'll be talking just in general routines at 7 p.m. Eastern time. So in about an hour and a half, we'll be on the fitness TikTok channel. You guys can check that out. I'll send out the newsletter pretty soon. But again, I appreciate you guys jumping on. We should continue to learn more about this market, right? Earnings season is the big catalyst here. So like I said in the newsletter, I guess you'll see it in the newsletter, but we really want to see, oh, what the heck is going on here? I don't know what's going on. We really want to see where earnings take us for these. Oops, there we go. Google on Tuesday. This is the big information, right? Google on Tuesday. Are they going to beat revenue, top line, bottom line, margins? What is the guidance? Microsoft, Visa. On Wednesday, Meta, Chipotle, Boeing, McDonald's. And Chipotle and McDonald's are going to give us some insight on the consumer. Honeywell and Boeing are going to give us some insight on industrial production. Okay. Intel chips, obviously, Meta, Microsoft, Google, and Visa too is going to give us some insight on the consumer also. So those are going to be some important earnings reports, and I'm looking forward to see how those come out and reporting it in real time or after the fact. So keep up. But yeah, appreciate you guys. We'll catch you later. Thanks for joining the stream. XO, I missed that. XOM, is it a short? Let's see, XOM. Oh, they have earnings also. I don't think so. I think from what I've seen, it looks like energy is actually going to have a bid. Energy's been outperforming. Let me see. I think I have it on here. It's energy by sector. Energy's been outperforming the last month, XLE. So that there's a rotation into Dow, like I said, into more value stocks, and that rotation should happen. So I wouldn't short XOM. They're probably going to do good. I don't know though. Who knows? Maybe because I know energy earnings are a little lower because they're versus last year. So we don't know, but it's forming a nice base. I mean, it is forming a nice base. I wouldn't be interested in shorting anything here. I wouldn't be. Nat gas starting to bottom out here. Interesting. All right. Copper. TLT. Oh, yeah, that's right. TLT. So there's big bond inflows. And I think this would be the next technical squeeze. If we get a lot of bonds coming in, if those earnings are negative and GDP keeps decelerating, we could get a big bid into bonds, the bond market, right? And the US Treasury could also do that yield curve control. And if these bonds go up, yields come down, you squeeze all the shorts. There's a big move in bonds, and I really think that bonds move up with the S&P and risk because you're lowering rates. That's going to cause more appetite for risk, but you're also, investing in protection at the same time. So overall, I still think we're in a bull market. Inflation's coming down. As long as it continues to make progress, I think we're going higher from here. All right, guys, I'll catch you later. Thanks for the broadcast. If you got any questions, then just, send them on the comments in the newsletter. I'll send that out right now. See you guys later. Thank you.